Erik Upin is here. He is the former chief investment officer of Stanford's endowment. He now oversees $15 billion in endowment-style money at Makena Capital, excuse me. Erik, good to see you back in the Inside Track. I think you heard some of the reporting that we've just been bringing our viewers. The Europeans, if you will, getting their act together a little bit, banding together the possibility of 100 to 200 billion euros coming out of European central banks like the Bundesbank through the IMF and back to European governments. Is this the kind of progress you as an investor need to see to reassure you about the future in Europe?
Yeah, I think it's a positive step, but a step, maybe a few bricks in the wall. Certainly, there is coordinated action. There's a real attempt to have it both be sizable and early. It may also be a function of continued deterioration. So when you see a lot of emergency vehicles surrounding a building, you can marvel that society can dispense those and dispatch those and have people go in and perform rescue operations, but the emergency vehicles are surrounding the building.
Well, that's the thing, right? Is it early? The emergency vehicles are surrounding the building, and it kind of feels to some people as though the building's been on fire for a little while.
Yeah, I think there really are three problems, and the third being the worst. The first was too much generation of debt. Secondly, too much of that debt going onto bank balance sheets under the guise of it being risk-free, and that was then levered up substantially. So even a small amount of write-down would be a huge hit to the banking system. And third, it's not just a problem as it stands today. It continues to grow and get worse. Solving today's problem may not solve the problem around low growth and still huge government expenditures as a percent of GDP.
Taking the glass half full approach, perhaps the best way to look at today's measure, along with the central bank coordination that we saw earlier this week, is they're all just buying time for Europe to come towards some fiscal coordination.
Yes, I would agree. I think the first is to stabilize and prevent calamity or severe market disruption. So that should be viewed positively, and that is the positive effects of having emergency vehicles respond to the scene of concern. Longer term, it's a spending, it's a balance of deficits, and whether or not that can be done under the current construct, it'll probably require tighter integration among a group of countries that didn't sign up to that level of integration when they began.
Erik, that's the glass half full scenario. I want to talk with you for a moment about the glass half empty scenario. This comes to us from Bruce Richards of Marathon Asset Management, a completely different kind of investor than you are. He's a credit investor, looks for distressed opportunities. He doesn't look at things from the same kind of long-term perspective as you do with an endowment mindset. But here's what he shared with us yesterday, his forecast for what happens in Europe. First of all, Greece defaults in the first quarter. Portugal and Ireland default very soon after that. Banks facing losses because of those defaults are forced to delever even more, up to $1 trillion of assets coming out of the bank balance sheets. European corporates, especially the high-yield ones, begin to go bankrupt. And by the third quarter of next year, Europe is in a full-blown recession. Jan Hatzius from Goldman Sachs was here just a few moments ago saying Europe is already in a recession. What do you make of that scenario?
Well, I think it's plausible and well thought out, and in many elements, I think are a very high probability. So I think the first issue is to stabilize the banking system. I think the market is both discounted and the general population is recognized the risks in Greece and to the essential sovereign, even up into France. Essentially, these countries are going to bed every night considerably more in debt than when they got up in the morning. So no matter how many days you work, you're never going to catch up to that problem. So one is write down, second, stabilize the banks. When you've done both of those come the issues of what have you done to the currency, what have you done to inflation, and what have you done to growth. The glass half full would be that these measures both stabilize, they close the boat's hole where water is rushing in and allow for growth to occur. But you need both, and a lot of work between now and then.
Erik, we know what Bruce Richards is doing. He's buying some of those assets that the banks are being forced to sell. He's looking for borrowers in Europe to go bankrupt so that he can buy their debt, maybe even take control of the company over the long term in a private equity fashion. You look at it differently. How are you investing? How is Makena investing with these European scenarios on the horizon?
Makena practices the endowment approach, and what we do essentially is asset asset allocation and manager selection. So to answer your question directly, the first is a focus on how much risk do you want to take in the portfolio in this environment? What speed limit do you want to drive on the road? And by the way, how wet and how icy is the road? And that should dictate some of the speed. And we think that there still are some considerable risks.
So you're not driving down the Autobahn right now?
Not at high rates of speeds. The flashes are on. And then secondly is manager selection. So we're asset allocators, manager selectors. And to your question, there are great investments in every environment. So as we look across different asset classes of interest, one is cash, because it allows you to be opportunistic. It allows you to weather some storms in a greater sense of calm and take advantage when things occur. There are interesting opportunities in private equity, natural resources, and even high-quality dividend and paying stocks. Lastly, in Europe, you could argue there's a lot of merit to having a two-pronged approach after more disturbances take place. One is the distressed area where there will be very cheap values, and the other is the very high-quality dividend-paying self-financing area, the global mega caps, if you will. And that two-pronged strategy as a contingency for Europe getting worse could be another idea.
Erik, we consider ourselves fortunate to have had you here this morning. Erik Upin of Makena Capital talking about the value of keeping a little bit of powder dry when it comes to Europe.